Would you invest in Thales if its profits come from war? Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Thales is that the Ukrainian war has been a massive catalyst for its share price. This is Andrew Stotz of Valuation Masterclass. Let's get started. Before we do, remember, this information is for learning purposes only. It's not investment advice or a recommendation. Now, let's look at the company, Thales. Here's a newspaper article that says Shell, Thales, and 3 more stocks to play a changing Europe. And here we can see in the aerospace and defense European trader, Europe is stepping up its defense spending. This company stands to profit. Ukraine war boosts weapons makers' stock prices, but revenue to take years to flow through. Let's look at this company, Thales. It has 3 main divisions on the left: aerospace, defense, and digital identity and security. They are selling a high amount into. In fact, defense accounts for about 2/3 of revenue of this company. It's a French company with a European history. It's mainly selling in Europe. 55% of its sales are in Europe, and that's followed by Asia and North America. So I was looking at this chart that someone posted on Twitter. It says, I put in the line start of invasion in Ukraine, and what we can see is that all of these defense companies are up. Thales, Lockheed Martin, Northrop Grumman, General Dynamics, and Raytheon. So Thales has been among the biggest winners so far, up 50% since November of 2021. We can in fact see that the Russia's invasion of Ukraine sparked the catalyst that drove the share price up. Investors are expecting this company to profit from war. So would you invest in it? Thales is likely to benefit from increase in government spending. Here we can see a chart of the France defense spending, which has been rising pretty continuously and has just gone above $60 billion. In response to the war, France announced to increase its defense budget. Currently, it's around 2% of GDP, in line with the NATO requirement. This number could go up to 2.5 as France plays an increasingly dominant role in Europe, particularly after Merkel is gone. There's less unity in Germany. So my question to you is it ethical as an investor to profit from war? I was looking at this article by Interactive Investor. It says ethical investing in Russian-Ukrainian war. And some of the points that I saw in the article, they had a sample of 2,058 Interactive Investor website visitors between the 9th and the 10th of March 2022. This company is the UK's, or this website is the second largest direct-to-consumer investment platform. Now, 42% of respondents believe that the Russian-Ukrainian war and the potential escalation of the conflict represent the biggest threat to global stock markets over the next 5 years, ahead of inflation, which is only 23%, and geopolitical tensions involving China, Brazil, and the Middle East, more broadly, that's 20%. Meanwhile, who cares about climate? Only 7% of respondents cited climate. 5 months on from the COP26, the UN climate conference held in Glasgow last year. So before I go into the model, I want to ask this question: is it ethical as an investor to profit from war? What do you think? Put your comments in the chat. I see one comment by Papa Benny who says, I think I wouldn't mind profiting from war. If it's a lose-lose for everyone, why not gain from it? What do you think? Send in your comments and let's discuss. So let me share some of my thoughts on it. First of all, we have all these people around the world talking about ESG, environmental, social, and governance. We have people talking about sustainability and impact investing. We want to do good with our money. So, is it really ethical to invest in a company that is supporting war? It's a good question. I think there's ways that you can look at it. You can say, well, countries need to defend themselves. So these companies that make weapons of war, we need them. Otherwise, how's a country going to defend itself from an aggressive neighbor? On the other hand, you could say that politicians make war. Most average people don't make war. So are we just feeding the politicians? Now, there's another thing, and that is that how much do the defense industry, how much is it in collusion and collaboration with the politicians? In the US, it's very, very close. The amount of lobbyists in Washington, very large. How about another point? Another point is this conflict between Russia and Ukraine could be stopped today if politicians would sit down and work it out. Instead, they're grandstanding and not working it out. By you buying a company that's profiting from war, it's like you are supporting not just working it out. Let's see what some other people say. Pear says, I think we should not support this kind of action. Okay. PPPP says they didn't force the war to happen. It's just a war that gave them more profits. Yeah, so they're just there. Of course, the challenge with that question is actually they may have pushed the war. If they profit from war, then you probably want to see war. So the incentives there, the question is, would a company do that? There's a lot of questions. So keep your questions and your comments coming in the chat. So how does consensus assess Thales? With the share price rally, some analysts downgraded to a hold recommendation. And we can see that over the past 4 months, analysts have constantly increased their target prices. You could say from an analyst perspective, the value of this company went from 100 to 133. $33 of value was added because of war. Let's see what others people say. Here's Nildor Lingenberry. Some investors might already be profiting from unethical companies and might not even know about it, like Nestle abusing children labor overseas. War might sound more brutal, but they could both be unethical. Yep. Amon Rat says, from an outsider's perspective, ethics in investment don't go along well since the beginning. PPPP says, I was thinking that the investor's job is to take profit from what they think is going to happen. Yeah, you can say that the investor's job is to take profit. Now, right now, we are seeing a lot of cases of investment management companies taking a stronger role. In the case of BlackRock, the CEO of BlackRock came out and said that he's going to be focused on ESG investing. My question to him is, what the hell are you doing? Why aren't you putting pressure through the companies that you own to get politicians to sit down and stop this war? Do you care about ESG? Pear says it's only the company that grows from war. Is it only the company that grows from war? Well, there are definitely many beneficiaries from war. One of the big beneficiaries from war is politicians. Because what happens is that politicians use patriotism, the appeal to patriotism, as a way of bringing people together in a country to say, we have a common enemy. Republicans and Democrats are going to work together. In fact, you can see it, Pear, that Republicans and Democrats are both supporting. Just now, they just passed $40 billion in aid that's going to Ukraine. So many people can benefit from war. So before we go into my evaluation, if you want to learn how to value companies like Thales, check out my 6-week bootcamp. It starts on May 23rd, and you'll get practical experience and you'll get access to my tools, tips, and tricks. You'll join a group of inspiring professionals, and hopefully you'll get a job or a better job through my network. Join for just $797 until May 16th. My goodness, that's only 5 days away. Just scan this QR code or go to valuationmasterclass.com/bootcamp. So let's take a look at my model. On the left-hand side, I have the P&L. And on the right-hand side, I have the valuation. Well, we can sum it up pretty quickly by seeing on the right-hand side that the free cash, okay, we can see that the share price is 116.8. And the chart shows us that the DDM valuation is 82.6. The free cash flow valuation is 103.2. And the free cash flow to equity valuation is 126. So what are my assumptions? I'm assuming a 10% growth in revenue in 2022, and then 5% beyond that. In fact, if we look at the company's revenue growth, let's go back to 2019, all the way back to, let's say, 2015. The average revenue growth was about 7%. So what would happen with the valuation if I increase the revenue growth to 7%? Let's say there's prolonged war and there's more spending. I'm going to change it to 7. Let's look at the free cash flow to the firm value of 103. What happens to that? That 103 goes to, well, not much change. So when we change the revenue over the next 5 years or so, it's not much change. Now, if we change it to 10, what would happen to that 103? Well, we would see the dividend discount model valuation start to come up. That's for sure. And this is something that we can play with. But I'm going to stick with 5% revenue growth to be conservative. Now, let's look at the gross profit margin. What we can see is if we go back over time before 2020, the gross profit margin of this company has been about 24%. So right now I'm forecasting 26. That's already pretty optimistic. Let's just keep it there at 26. And I'm going to take the 26.5 down to 26. And that brings the dividend discount value down to 79 and the free cash flow value to about $100 and free cash flow to the firm to about 124. Now let's also look at some of the assumptions that I've made in the value model here. And the first thing is I'm estimating a cost of equity of about 9%. Also a weighted average cost of about 7%. I know some of you guys are on this call and listening in have already been into the Valuation Masterclass, and therefore you recognize this. I know like Lee recognizes it very well. Now here, what we can see is that the return on invested capital of this company has been, most recently, it was about 17%. In the discrete period, I'm expecting it's going to go up to 24.5. And then I'm going to expect that it fades down to some level because a company can't maintain its profits forever. Now, I could get a little bit more aggressive with this, and let's just raise that to say that it's going to fade down to about 120% of the weighted average cost of capital. In other words, there is some fade over time, but the fade is going to fade from 24.5% return on invested capital down to 15. That's still far below the weighted average cost of capital, or sorry, far above the weighted average capital of 7%. And that gives us a free cash flow valuation of about 106. I would say, based upon this, that if we look at the company from the perspective of free cash flow to the firm and free cash flow to equity, that the move in the share price has probably fully compensated for the value that's coming. The only way that you can argue opposite is if you would say that the revenue and the profits of this company are going to really start to rise over time because of their business rising because of war. So that is my breakdown of Thales. And I'm going to take it back now and just talk briefly about this idea of ESG. It's all the rage. ESG. But I challenge you to think about the fact that with ESG, we are asking companies to do what governments used to do. We are asking fund managers and asset managers like Larry Fink at BlackRock to be the judges and the juries and to set the requirements for what they want from the economy and the environment and all that. I challenge you to think about the risks of using corporations and using investment management companies to put pressure on corporations to do what traditionally we would expect that governments would do. Could anything go wrong? It's something worth thinking about. I want to thank you all for joining me in today's Valuation Masterclass case study, where we looked at Thales and we asked the question, would you invest in a company whose profits come from war?